In class 6, what we'll do is we'll finish up the problem we finished up last class, but I want to show you the actual swap diagram. I promised you that in last class. We also ended last class doing the dollar duration gap analysis. So in this class, what I want to do is prove that that actually works. Then we'll work an entirely new balance sheet immunization problem. Usually the first problem students just, well, it's just so much, it's hard to sink in. But as you see the second problem, I think you'll start seeing that it's really not that difficult of an exercise. It's pretty logical in the way it's set up, and so I think you'll find that it's not too difficult. So last class we had a swap. We had AAA and triple B. Remember, AAA had a competitive advantage in fixed rates, so they went out and borrowed at Treasuries plus 125. This is just their normal borrowing, maybe $500 million or whatever. Triple B, they had the comparative advantage in floating rates, so they borrowed at LIBOR plus 20. And then they entered this swap where Triple B paid T plus 140 to Triple A, and Triple A paid LIBOR to Triple B. What we're asking for, and they pay that into the swap. This is the swap here. So off of some notional amounts. So we're going to see, and when we did the dollar duration gap analysis, our swap was $321 million. So, you know, but here they're borrowing money. So it's, you know, it's hard to say exactly what the notional amount would be because there's so many numbers going on here. But the swap is some amount, probably pretty close to what their borrowing is. And so there's going to be some notional amount, maybe 500 million, that they'll multiply these numbers by, and they won't actually receive this and pay that. They'll just net the two together. We talked last time about master netting agreements, where these swaps, everything's just all netted together. They pay that into a swap dealer of some kind. This is the true counterparty. Triple A's counterparty is not Triple B. Triple A's counterparty is the actual swap dealer, some investment bank like JP Morgan or Morgan Stanley. And Triple B's counterparty is that same investment bank. So Triple A and Triple B may not even know each other exist, that they're doing this swap. So Triple A borrows at T plus 125. They receive T plus 140 from Triple B or from the counterparty, and they pay the counterparty LIBOR. Triple B borrows at L plus 20 in the normal debt markets. They receive L and they pay T plus 140. So what's the ultimate borrowing cost for AAA? Well, they paid T and they paid 125. Anything they pay, I put a plus sign by it. They pay T, they pay 125. Then they receive T and they received 140 and they paid L. When you do the math, they end up their net cost after all of this is done, they end up paying LIBOR minus 15, which was much lower than what they were paying before. Remember, if they borrowed in the floating rate market themselves, they would have paid LIBOR plus 10, but instead they got away with paying LIBOR minus 15. So they saved 25 basis points by entering the swap. Triple B, they pay LIBOR plus 20 as their normal borrowing. They receive LIBOR, so that reduces their costs. That's why the plus sign is the cost of debt, and minus sign is the reduction in the cost of debt. They then pay T plus 140 into the swap. So they end up, the L's cancel out, so all they have is T plus 160. Remember, if they'd done this themselves and gone out and borrowed fixed rate, they would have borrowed at T plus 185 because of the term structure of credit spreads. Lower quality entities have to borrow at higher rates. And essentially, remember that 25 basis points cheaper. Essentially, we discovered that AAA was 10 basis points cheaper than Triple B on short term and 60 basis cheaper on long term. So that 60 minus 10 is 50. We essentially split that 50 and gave 25 of it to AAA and 25 of it to Triple B. So they're both cheaper. AAA may want to borrow floating rate, but if they borrow like they normally do, they would have paid LIBOR plus 10. By entering the swap, they can now end up paying LIBOR minus 15, 25 basis points cheaper. Triple B might have preferred the borrowed fixed rate, but because they're better off in the shorter term debt, they borrow short term, and then they swap to long term, and they end up saving again 25 basis points. So both entities come out ahead. We finished the last problem doing dollar duration gap analysis. And so what we want to do is prove that it works. And so we came up with an answer that they needed to enter a swap of 321.5. We figured out in the previous question they need to be on triple B side. What is triple B doing? Well, triple B is paying fixed and receiving floating. So if you pay fixed and receive floating, you're increasing the duration of liabilities. But how much of the swap do they need? And we decided they needed a swap of 321.50. All right, so this is the dollar duration gap analysis. Let's see if we can prove that. So their duration of liabilities will now be, remember they started off with 750 in liabilities with a duration of 3.75. They have now added this swap, 321.5 with a duration of 5. You divide that by 750 plus 321.5, and that gives you a new duration of liabilities. It increases to 4.215. So the duration of their liabilities went from 375 to 4.125, but their liabilities also increased because we have that swap. Even though it's notional, we still cover it. And so let's look at the duration. Now you don't have to actually calculate this on the exam. I'm just giving you this. This is just proof. So now what is the duration of net worth? Well, that's going to be, remember the formula, duration of assets maybe I can bring that formula down. And you do have to know this formula for the exam, although the exam will probably be somewhat open book, which is sad. So there's our duration net worth. So the duration of assets, remember, that is 4.42 minus the dollar amount in liabilities. Well, now our liabilities are 750 plus 321.5. We divide that by the dollar amount in assets, that's $1 billion. We take all of that and multiply by our new duration of liabilities, which is 4.12505. You multiply that by leverage, but if we did it right, everything in here is going to equal 0. Now you won't get exactly 0 because this is a rounded number. It actually goes out. It's 4.125058329 and keeps going on. But if you go out, if you do this in Excel and go out enough decimal places and use that, you will get a duration of net worth of exactly 0. And that's because we've essentially expanded our liabilities, and now our liabilities are greater than our assets. And because of that, our duration of liabilities can be shorter than our duration of assets. And that will give us a duration of net worth of exactly 0. So you might try this. I might let you try it on the next problem and see if you can get it. So let's move to the second problem. So here we have assets of $1.1 billion. The cash has a duration of 0, as we said before. The loans have a duration of 3.3. That's getting closer to a normal book of business for a bank. Debt, their debt has a pretty long duration, 3.9 years, and they have quite a bit of debt. This firm's more leveraged than the previous one. Remember, the previous one had assets of $1 billion and net worth of $250. This one has 1.1 and 1.5. So this is more levered. The duration of assets, we know 200 divided by 1.4 times 1.1 is 0. So we just have to take the rest of it. 900 divided by 1.1 times 3.3 gives you a duration of assets of 2.7. So then we'll do the duration of net worth. Here I remember to show you the entire formula. So duration of assets, 2.7 minus liabilities divided by assets times 3.9 times our leverage, which is assets over net worth. And here we get a duration of net worth of negative. You can have a negative duration. What this means, when interest rates rise, this firm will actually make money. They will do well. It's when interest rates fall that they will be in trouble. So this might be the norm today for banks. Banks may be worried about that interests are at their all-time lows. You can only go up from here, and so maybe they are actually pinpointing a negative duration on their net worth so that they'll benefit if interest rates rise. What happens if interest rates were to rise 200 basis points? So you take minus duration times the change in yields, or minus 4.91 times plus 0.02, and so their net worth would actually go up 9.82%, or go from 150 up to 164.7. Now, if we want to immunize this, then we'd want to raise the duration of net worth, make it further away. Make it closer to zero. You want to move it to zero, so there you would actually decrease the duration of liabilities. And you might want to think about this before you do the swap problem. Here we have a negative duration of net worth, so we want to reduce the duration of liabilities. How do you do that? Well, you start with fixed rate and you swap in the floating. All right, so let's look at this. Who has the advantage? Remember, on this, you put the difference over on the side. What's the difference here? Well, here, AAA is 100 better, 100 basis points better. Here, AAA is 150 basis points higher. So this is the opposite of what you'll probably see on the exam. You expect it to be the opposite. You would think AAA would be much cheaper on fixed rate than it is on floating rate, but this one's a bizarre one, so this is a really unusual entity. So where does AAA, so who has the advantage in fixed rate? Well, wherever this number is higher is where AAA has the advantage. Wherever this number is lower is where BBB has the advantage. So here, BBB has the comparative advantage in fixed rate. Again, I told you that's extremely rare. Usually the higher quality company will have the advantage in fixed, the lower quality will have the advantage in floating, but here I switched it. That's probably unlikely that you'll see that on exam, but I set this one up just to make sure you're thinking through it. So what's the ultimate borrowing cost for AAA and BBB if these two entities borrow in the markets where they have the comparative advantage? Well, BBB has the comparative advantage in fixed, so they're going to borrow at T plus 150. AAA has the comparative advantage in floating, so they'll borrow at L plus 10. And then they're going to enter into a swap where AAA pays Treasuries plus 15. They pay T plus 15 to BBB, and BBB pays LIBOR. So AAA receives LIBOR. BBB pays LIBOR, receives T, receives 15. I don't know why Bill Gates changes my dashes all the time. So what's the ultimate cost? Well, L plus 10 minus L, so the L's disappear. So you have T plus 25. Where were they borrowed before? It would have been T plus 50, so they're 25. Again, the difference is 50. So AAA is going to be 25. You can actually do that math. Do the difference and the difference, which is 50, and split that 25 and 25, and AAA will get 25. And BBB, you can already guess, BBB is going to be LIBOR plus 135. Let's see if that's the case. They pay T plus 150. They receive T, so the T's disappear. They pay LIBOR, so 150 minus 15, you end up with L plus 135. You know you did the comparative advantage wrong if you end up with two T's or two L's on one side. So wherever you start, AAA started with an L. They receive an L. The L's will cancel out. You should end up with a T. BBB started with the T. The T's cancel out. They start off with an L. So you can see BBB's the one that they started off fixed. They ended up floating, so they're the ones shortening the duration of their liabilities. So they need to be on triple B side because they need to increase the duration of net worth. So they need to reduce the duration of liabilities. So swapping from fixed to floating. And remember, these two words are extremely important. The duration of. So many students say they need to decrease their liabilities, but no, they need to decrease the duration of their liabilities. There's more to it than just liabilities. And the same thing, we need to decrease, we need to increase the duration of net worth. So we're not increasing net worth, we're increasing the duration of net worth. This transaction won't have any impact whatsoever on the level of net worth. It just increases the duration of net worth. Make sure those words, the duration of, are in your answers. Otherwise, you're not saying it correctly. Now we'll count off for that. And then we'll use dollar duration gap analysis. So remember, the duration of assets was 2.7 times the dollar amount in assets minus 3.9 for duration liabilities times the dollar amount of durations. We get, and here, whatever you get, just put it as an absolute value. We already know we're going to go from fixed to floating. So we're going to pay floating, receive fixed. We just have to know what the notional amount is. The positive or negative numbers are not important. The investment bank has a good 10-year duration interest rate swap to order to invest in. So you take the dollar duration gap, 735, divided by 10, and that gives you 73.5 is your notional amount. So if you want to try checking that, we can try that. So the duration of liabilities is going to equal, well, here you do have to use the minus sign. So you got 950 times 3.9 minus 73.5 times 10, and you divide that by 950 plus 73.5. And that will give you a number. I'll let you work this on your own. You then get the duration of net worth. Y'all try it and tell me if it worked or not. Duration of net worth is going to be duration of assets, 2.7, minus the dollar amount in liabilities, that's 950 minus 73.50, divided by the dollar amount in assets, 1100. All of that times the duration of liabilities times leverage. You don't really have to do the times leverage because if you did it right, everything inside here will equal 0. And that should equal 0. So you try this on your own. I don't want to do it for you. I want you to try it and see if you can get those numbers. But that's the way you check it. So even though we really don't have 73.5, we don't have any dollars. Remember, we didn't actually pay or receive that amount, but it's going to change our liabilities as if we did have that amount. And that's what's really critical to the swap working. All right. So good test case for you. If anyone can't get this to work, email me and we'll, I'll look at it again and see if I did something wrong there in the calculations. I think I got that right though. Oh, I did make one mistake right there. So sorry. So yeah, you got to make sure you subtract. So if you're on the side where you're starting fixed and you end floating, then you're actually going to subtract this number. That's where the absolute value actually doesn't make sense. You actually want to know what this negative sign is. So if this is a negative sign, then yeah, you want this to be a negative sign. So I probably should have kept the sign there. But you don't need it for the answer to the question. You don't put negative 73. You don't say we want a notional amount of negative 73.5. What you say is we want a notional amount of 73.5 where we will be on triple B side. So we want to pay floating and receive fixed. So we want to swap 73.5 swap where we pay floating and receive fixed. Another question I like to ask on the exam is, You often hear this transaction referred to as interest rate swap arbitrage. Is it really arbitrage? And the answer is no, it's not really arbitrage. Arbitrage is when you have a gain without any investment and without any risk. Remember here, there's a gain, but it's not without risk. There is no free lunch here, because while you're eliminating your interest rate risk and you're getting your debt cheaper, you're doing that by increasing a new risk, a credit risk called counterparty risk. So let's talk a little bit more about counterparty risk. So with counterparty risk, it's a special type of credit risk, mainly because sometimes you owe the counterparty money, sometimes the counterparty owes you money. And so, and your exposure is to that investment bank that set up the swap. Now, you have some protection. If your swap is worth $50 million, your counterparty will have to put aside maybe $50, $60 million into a collateral account. It's called hypothecation. It's essentially giving you collateral for their market value. So setting aside that, when I talk about the pension plan. For me, it wasn't a big deal because I always had plenty of assets that I could set aside like that. But you actually set it aside in an account. Your custodial bank will actually separate those assets out so that so the investment bank's creditors cannot get their hands on them. Even though they're investment bank's assets, but they will actually separate them per the swap contract, so that if they go insolvent, you have first dibs on those assets. So your exposure changes over time as interest rates change, and your exposures can change really quickly because interest rates can move dramatically one day to the next. Now, every day interest rates change, that collateral account will change. So if the market value is 50 million today and tomorrow it goes to 80 million, then tomorrow your investment bank will have to add extra money, an extra 30-something million dollars. However, a good example is 2008 when Lehman Brothers went under. If on Friday you have a swap contract with Lehman Brothers that's worth $100 million, and then there's a horrible weekend when everything goes horrible, and interest rates move a bunch. So on Monday, your interest rate swap with Lehman Brothers is not $100 million. Now it's worth $175. So you had $100 million in collateral on Friday. Now Monday comes around, you have $100 million, and Lehman Brothers needs to add another $75 million to your swap. They can't do it. They're insolvent. And so you went from $100 million market value to $175 in one weekend because it was just a crazy weekend. But your counterparty is insolvent. They don't have the money to put into your counterparty, your collateral account. And so you'll have $100 million sitting there, but you'll lose the $75 million. And so when we're looking at counterparty risk, we define it as potential exposure, because our actual exposure is not a risk because we have the collateral sitting there. Our risk is from one day to the next, that actual exposure will change so dramatically at a time when the counterparty is insolvent that they cannot add more collateral to your account. And then you'll just be a normal creditor lined up to try to get your money back from this swap dealer. And again, this is why swap dealers do these netting arrangements that you read about when you're doing your first paper, when you're doing paper one, these netting arrangements. So if JP Morgan has, say, 20 arrangements with Morgan Stanley on the swaps, sometimes they owe money, sometimes Morgan Stanley owes them money. They'll do a master netting arrangement, so they'll net all those together. If they don't do that, and it's a good example, let's say JP Morgan has 10 swaps with Morgan Stanley. 5 are positive market value and 5 are negative market value. If they do the master netting, then these might net out close to zero and there's no credit exposure. If they don't do the master netting, what's going to happen if Morgan Stanley goes insolvent? The 5 that have positive market value, JP Morgan will just sit in there in line with all of the creditors to try to get their money back from Morgan Stanley. the 5 that are negative market value, the creditors of Morgan Stanley are going to come to JP Morgan and say, you got to pay us. And so what will happen is if this is $400 million and this is negative $400 million, and let's say there's not enough collateral there, let's kind of forget about the collateral, then the creditors of Morgan Stanley, when you come and say, hey, Morgan Stanley owes us $400 million, the creditors are going to say, well, you stand in line with everybody else. If they have $400 million when we finish this bankruptcy, we'll pay you back. If not, no. But the creditors here on the $400 million are going to tell you, JP Morgan, you pay us immediately. With the master netting agreement, all of that nets down. So it's just whatever residual is the only exposure you have. So investment banks use master netting arrangements, and they usually require for all of their customers. Even if you only have one swap contract, it wouldn't really matter in that case, but they just have it as a standard part of the contract. But that's the potential exposure. You don't really have any actual exposure at any given time because you're always getting collateral whenever the market value changes, until the market value changes really fast in one day and the other side can't pay you because they're bankrupt. They don't have the money to pay you, so you'll have an exposure there. So how do you calculate this? We'll talk about value at risk. I might come back to this. But value risk is essentially, it's a simulation. I use historical value at risk. We'll get into that later in the class. What I did is I just went back historically and looked at how fast interest rates could change in just a matter of a few days. And I came out with maybe a 1% event, 1% of the time, my market value on the swap could rise this much in value. And that's what I would define as my potential exposure. And that's what we use as far as our credit exposure to JP Morgan or Morgan Stanley. So it is a very common way of calculating that potential exposure. You should be concerned about it. 2008 was a huge year. Yes, Lehman Brothers went under, but Merrill Lynch and Morgan Stanley and Goldman Sachs did not. However, if Merrill Lynch had not been bought out that weekend that Lehman went under, if Bank of America had not come in and bought out Merrill Lynch, you would have seen Morgan Stanley go under. You probably would have seen Goldman Sachs go under. It would have been a domino effect. It would have just been a huge cacophony of just firm after firm going under. And so it can be really dangerous. And part of the problem here is it's dangerous all at the same time. So you might try to diversify this risk by using 6 or 7 different counterparties. But if you get a year like 2008 where they're all crashing at the same time, then yeah, you've got a problem on your hands. All right, so we'll talk more about value at risk later in the class, but it is the way to calculate potential exposure, and it's the way I calculated it when I was doing swap contracts. All right, so we just did balance sheet immunization for banks. We might work another problem in one of our online sessions, or I might have asked some of you to work a problem. So there are other examples out there, so you can definitely get more and more practice with this. But this is banks. Banks are very, very straightforward, mainly because both their assets and their liabilities are fairly short term. There's not a lot of risk of what we call prepayment risk. Banks do have mortgages, and people do prepay their mortgages early, but banks tend to securitize those and get them off their books. Auto loans are not usually paid early. So banks' liabilities are fairly straightforward. Their assets are a struggle, but not because of interest rate risk. Mainly it's because of credit risk. So when you're doing paper 1, you're going to find that the price risk or interest rate risk section is probably a lot shorter than the credit risk section, because credit risk is a much bigger issue for banks. Now, we can look at other entities, pension plans, life insurance companies, especially the deferred annuities, and endowments. We are going to spend quite a bit of time here talking about pension plans. Now, I realize pension plans don't really exist anymore. Most firms have shut them down, but they're a great example of balance sheet immunization, and they do still exist, maybe for older employees. I still have a pension plan from where I retired from. They shut their plan down, but I accumulated 20-something years worth of benefits. And so they still have a liability. It's a few $billion still, so it's not inconsequential. They're actually trying their best to get people to take the lump sum, and they're trying to just essentially shut the plan down as much as they can. So what you're going to do, and I strongly recommend, and we'll talk about this, I'm going to get into pension plan immunization, but you need to have read the blog, my blog on this, before you get into this section. And we'll get into that in quite a bit of detail. We're going to go through that blog in detail, but you need to have read it. It's a big question on the exam. So, but let's just talk quickly through pension plan balance sheet immunization. So first of all, what is a pension plan? Most of you, when you start your first major job, if you don't already have one, your firm will probably give you a 401k plan, or if you're working for a school or government, a 403b plan. Those are plans where you decide where to invest the money. You're building your retirement. You're investing your money. They'll give you some options, some stock options, options in stock market and the bond market, maybe international stocks, whatever options they have in their 401k plan. You decide how much you want to invest. The tax code lets you invest a certain amount with major tax advantages. You decide what you will invest in. So you take all of that risk. A pension plan is very different. This is where the company sets the money aside, and then when their employees retire, the company promises to pay that employee a monthly income until that employee dies. And some pension plans actually have cost of living adjustments, and where they will actually increase that income once a year for whatever inflation is. The pension plan I have, it increases every year by 80% of the cost of the consumer price index. So it has an inflation protection, not 100%, but up to 80%. Social Security is a type of pension plan that we as taxpayers together fund. It has a cost of living adjustment to it, and the cost of living adjustment is 100%. So you do, in a sense, have a pension plan because that's what your Social Security investments are. Whether you think it will be there when you retire or not, that's a separate question, given all the baby boomers and the financial difficulties our country's going to have during your lifetimes, I'm sure. But a pension plan is essentially an employer promising a monthly income for the rest of the life of their employees once they retire. You don't have to retire from the company. You will vest your pension plan. So if you work for a company for 20 years and then go work for another company, you still will get this pension for those years that you vested and you accumulated benefits. These are what we call long tail line liabilities, because you might retire at 65, but you may not die until you're 95 or 100. But also, if you're a 30-year employee, you're accumulating these benefits. You may not retire for 30 years, and then you might live for 30 years after you retire. So you still have 60 years before this thing gets paid out. So they have very, very long tails. And that's extremely important to understand when we get to interest rate risk. This is like very, very long-term debt. You owe someone money and it's very, very long duration. Remember, we said banks tend not to have difficulty with interest rate risk because their assets and liabilities both tend to be fairly short duration. Well, pension plan has very long duration. They go on until every single participant in the plan dies. That's why UTSA's pension plan, even though it was shut down 15-something years ago, is still a few $1 billion, because there's still a lot of people alive drawing a pension. I have a pension there which I won't even think about until I turn 62. So, I've still got a few more years there. The liability is a fixed cash flow plus inflation, but it is a fixed cash flow. So its value today, this is extremely important, its value today is the present value of those promised cash flows at some discount rate. According to GAAP, that discount rate is the current rate on investment grade corporate bonds that has the same duration as your pension plan's cash flows. All right, so that's pretty critical. So, you know, a typical corporate bond, a long-term corporate bond might have a duration of 8, 9, 10 years. 10 years is about as far out as you can go. A 30-year treasury could have a duration of, say, 18, 19 years. So it's hard to get durations above 15 years in the bond market. But a pension plan could have a duration of 22, 23 years. They're extremely long duration securities, liabilities. So it's a liability with very, very long duration. What does that mean? It is very sensitive to interest rates. Its duration can be much longer than 18 years, much longer than almost any bonds available in the U.S. So remember, we're talking about balance sheet immunization. We have this liability that's very sensitive to interest rates. So we want to have assets that are very sensitive to interest rates, but those assets don't exist. We can't find bonds that have very, very long durations except the swap market. That's where we can get that duration. So how are we going to handle this? So hopefully, again, you've already read this article. There's an article by Robert Arnott. I want to start with that. And then you're going to see my blog. My blog asks a much more intricate question than is being addressed in Can We Keep Our Promises? So I'm going to go one level higher. Let me show you this question. I just want to get you thinking about it before we get into the Arnott question or article. And here's the question. And I want you to, maybe put the video on pause after I ask the question and maybe put bullets down on how you would answer this question. I'm not going to answer it in today's session. We'll definitely get into it later, but this is the question I'm going to ask on the exam. What I find amazing about this question is about as basic fundamental finance as you can find in any question, and yet very, very, very few, in fact, it might be none. I've never found an undergraduate student yet that really has a good grasp on how to answer this question. So this is a critical thinking question. How do you bring together everything you've learned so far in finance and answer this question? So let's say if you can borrow, we're talking about corporation, so I'll change it. If a corporation, we might talk about this from you as an individual as well. If you can borrow at 4% and you believe the stock market has an expected return of 8%, will the value of the corporation increase if they borrow $1 billion at 4% and invest in the stock market to make an expected 8%. All right, let that sink in. There's the question. Corporation, they can borrow money at 4%. And let's say they can borrow $1 billion at 4%. Should they take that $1 billion and invest it in the stock market where they think they can make 8%? If they do that, would that add value to the stockholders? And how in the world would you answer that question? So I want you to think about it. It's answered in my blog, but I want you to think about it before you read my blog. So I probably should have said that before I said read my blog first. But that is the question. Extremely important question. If you can answer this confidently, then you know finance. Now, if you're an actuary finance major, actuarial science major, the actuaries I've dealt with in my career, they could answer this question better than the finance people. They seem to know the theories better. So don't use the fact that if you're an actuarial science major be an excuse for not having to understand this. You should know it just as well, if not better, than the finance majors. All right. So there's the question. Before we get into that, I want to cover Robert Arnott first. Here's the original article by Robert Arnott. I'm a huge fan of Robert Arnott's writing. At the time he did this, this is from his editorial. He was the editor of the Financial Analyst Journal. That was the best years of the Financial Analyst Journal. I haven't read it in the last few quarters. I should get my Financial Analyst Journal out and go and see what's there. But when he was editor of it, the articles were so much better written and so much more practical. So here he's writing a letter. I mean, since he is the editor, his editorial comment. I met him a couple of times, but I met him once. He came by UTSA to talk about a project he was working on. And it was right when he announced, or he was ending his reign as editor of the Financial Analyst Journal. So I got the chance to tell him that, man, when you were editor of the journal, it was the best journal ever. He probably thought I was just buttering him up, but I was real sincere. He's an excellent writer. He's an excellent speaker, an amazing speaker. When he spoke at conferences, people would leave his talk and call their brokers and start making trades. He was so convincing. Very powerful. I do recommend you read his articles. Now, as great as a writer that he is, this is not one of his best articles in terms of the quality of the writing for just the general public. He uses a lot of jargon in this. My students find it very difficult to read through this, even if they're finance majors. They have difficulty reading this article because of the huge amount of jargon that he uses. And so what I did is I rewrote his article, and you have my rewritten version of his article. It's a Word document. I made that available to you as well. I want you to read. You do not have to read the original Arnott article. You might try it to see if you can catch his jargon. I'll tell you some of the jargon that he uses. One of the problems with his editorial is on some of his jargon, he has 3 or 4 terms that mean the same thing, and he switches between them. And if you're not familiar with those terms, you may not know that he's talking about the same thing because he keeps switching his term. And that's just because he's so much into this that he knows that asset risk, beta risk are the same, pure risk and alpha risk are the same. He just uses those interchangeably. So what I did in this article is I simplified the language. I used the same terms over and over again. And there's one place where he has some math where I greatly simplified his math. And you're going to see this. We're going to walk through this table, and I'll show you exactly how I did this table because I want you to understand this table. But it's much simpler than what he did. If you go back and look at his article, he does it in a much more complicated way. It makes sense to the people he's writing to, but to my students, it's a little bit too much. It's a little overkill for what we need. So let's introduce this article, and you'll actually see this in my blog as well. He is going to talk in this article about 3 risks. I expand his 3 risks into 4 risks. And so I want you on the exam to be able to explain these 4 risks. Now the 3 risks that he talks about are pure risk, asset risk, and asset liability management risk. Pure risk is also known as alpha risk. Asset risk is also known as beta risk, and ALM risk is just ALM risk. So we need to define these 3, and then I'm going to add one more to that, which I call career risk, which is closely tied to pure risk. All right, so that's the one extra one I add. You'll see that one in my blog. I didn't add it to his article because I wanted to keep it pretty close to his article. So what is pure risk? All right, you want to have a deep understanding of pure risk. Pure risk is the risk that your portfolio falls short of the portfolio of your peers or falls short of market benchmarks. So if you're running a pension plan, pure risk is that your pension plan assets are up 7% when the average pension plan is up 8.5%. R is the risk that your pension plan's stock portfolio is up 7% when the S&P 500 is up 8%. That's pure risk. It's also known as alpha risk. It's the risk that you underperform some benchmark. And you get alpha risk because you're trying to beat the market, so you make some bets. Maybe you allocate more to small company stocks, and small company stocks don't do well, big company stocks do well, and so you have relative bad performance. That's called peer risk or alpha risk. A good term that you could actually go out there and Google is alpha beta separation. I might talk about this later. I think I will talk about this later when we talk about hedge funds. But alpha beta separation, what does that mean? So hedge funds are an alpha beta separation type of strategy where you're trying to get, oh, I typed it wrong. It's not asset, it's alpha. Alpha beta separation. So you might do an internet search on that term and see if you can figure out what it's talking about. Try to find a good Wikipedia site or some hedge fund that's talking about it. That I did some alpha beta separation when I was at UTSA. I'll probably talk about it when we get further here. I did it in our pension plan and in one of my mutual funds. So you have both of those terms, alpha and beta. Alpha is the part where you're trying to beat the market. Beta is which markets are you exposed to? Are you buying stocks? Are you buying bonds and stocks? Are you doing large cap stocks? Are you doing small company stocks? Are you doing international stocks? So that's the beta side. So peer risk is underperforming your peers. That's where I bring in career risk. Your biggest career risk is underperforming your peers. And you'll see that in my blog. The biggest risk you have in finance is that you're up 6% when your peers are up 8%. The market doesn't seem to care all that much. If the market's down 10%, if you're down 9%, they're fine with that. As long as you fail with everybody else, you won't lose your job. In fact, you could be down 9% when the market's down 10%, everybody be happy with you. And then you could be up 10% when the market's up 12% and you could lose your job. It's an interesting part of finance. Someone says, hey, how did you get fired? Well, my portfolio was up 10%. And they say, well, that sounds good. You made 10%. That sounds pretty good. Yeah, but my benchmark was up 12%. And then the next year you get a new job and your friend asks you, how did you do? You say, well, my portfolio was down 12%. And they say, oh, well, did you get fired again? And say, no, because my benchmark was down 15%. So I didn't get fired. I actually got a raise because I beat my benchmark. That's where peer risk and career risk are tied together. It's a bizarre world of finance. I'll tell you the story now. I might tell you again because I always forget if I've told it before. But I still remember the day that a hedge fund came into my office. The hedge fund manager, oh, they were so excited. They came in and said, this is during the 2008 crisis when everything was down dramatically. They came in and said, we love these type of meetings. We're always really excited to meet with our customers. In years like this, we had such a great year. So they sat down. And they said, our portfolio was down 20%. I was like, okay, well, what's the good news? Well, the good news is our benchmark was down 25%. And most hedge funds had underperformed their benchmarks. So they were really, really excited. From a pure risk standpoint, they were down 20% when their benchmark was down 25%, and most of their competitors were down much more than 25%. And they were really excited, and they thought, wow, this is great news. And I pointed out to them and said, yeah, but you lost a fifth of my money. And I remember his response was, oh, yeah, that thing of you losing money, yeah, well, we don't care about that. And that is finance. Finance is wholly focused on peer risk and almost entirely ignores career risk. And why is that? So my blog talks about that. Now, career risk is not in this article, so Arnott does not talk about it in this article. He does mention, though, that most of the focus of finance is on peer risk, and almost no focus is on asset liability risk. He then said, now you have to keep all this straight in this article, most of our focus is on peer risk, but most of our risk is asset liability management risk. And he shows that with a table down here. He shows how much impact each one of these risks could have on the earnings per share of the firms with the 9 largest pension plans. This is back in 2003, so this is an old article. But earnings per share, your worst case scenario with peer risk would it's going to cost you $1.28 in earnings per share. With asset risk, it could cost you $2.61. With ALM risk, it could cost you $5.12. So your biggest risk is ALM risk. And yet, the market is focused almost entirely on the smallest risk. And I saw this in the industry. 95, 96, maybe 99% of their effort was on pure risk. And for most pension plans, they completely ignored asset liability management risk. So the typical pension plan would focus 96, 97% of their time on alpha or pure risk. The rest of it was on asset risk, and even that they would only do once a year where they set up their asset allocation, and they spent almost no time on the biggest risk. That is, to me, the biggest issue with finance. We spend so much time on the smallest risk, and we spend so little time on the biggest risk. And why is that? Because that's the way we're compensated. We are compensated based on pure risk. We are not compensated based on ALM risk. If we change the incentives, if we change the compensation, it would change this world. Now, on the life insurance side, life insurance actuaries, they're paid based on ALM risk. And so they manage their liabilities a lot differently than pension plans. And because of that, they do much more intelligent things. I remember the whole reason I got focused on asset liability management risk for my pension plan that I was responsible for was in a conversation I had with one of our life insurance actuaries. And I said, okay, John, his name was John. I said, John, your liabilities are very similar to our pension plan liabilities, and yet you're 100% bonds and we're 70% stocks. Why is that? Why in the world were two liabilities that look very similar? Why would one have 100% in bonds and one would have 70% in stock? And he looked at me, he didn't even flinch, he didn't even wait a second to answer. He knew immediately. His answer was, because you guys on the pension side are so stupid. You're crazy. You don't know what you're doing. And John, boy, I had a huge respect for John. Very brilliant guy. I learned tremendously from him. When he tells me what I'm doing is stupid related to interest rate risk, boy, I listen. He got me to step back and really listen carefully to what he was saying. And I really do believe pension plans are getting shut down all over the world. And they're a huge mess for large cities and governments that still have pension plans. You know, you look at the post office loses a lot of money, not because of the post office operations, but because of their employee benefits and primarily their pension plan. Why are corporations shutting down pension plans? Why are states and cities and why are firemen unions, teacher unions, why are these large pension plans backing up these states and unions? Why are they in such a disaster? And why are corporations shutting down pension plans? I truly believe it's because pension plans were compensated based on pure risk. If they had been compensated, their portfolio managers had been compensated like life insurance actuaries are based on ALM risk, I think these plans would all be in good shape. Corporations would still have pension plans, which I think they should. I talk about that in my blog. But that just gives you perspective. We're focused on the wrong risk. And we'll talk about that later. I think that's an issue you're going to see when we get to price risk and other things. I want to bring this back a few times because I think it's one of the critical parts of this class. You're going to find out when you graduate and you get your first job, you're going to discover that you're going to be compensated on the smallest risk. Many times you'll be compensated for managing the small stuff, and you will not be compensated at all for managing the big stuff. And I'm going to encourage you to try to change that equation. I changed that equation at UTSA. I got everybody focused on the ALM side for our pension plan, but you will have to fight hard to get that changed where you're working. So the key is that we need to understand this ALM risk. Now this article is specifically talking about interest rate risk, and his solution is balance the three risks. There's Arnott's solution. Balance the three risks. I disagree with him on that. Now, who am I to disagree with Robert Arnott? But he says balance the three risks. Now, I actually think Arnott might possibly agree with me on this. He makes his argument in here why he disagrees with me, and we'll talk about that argument. My solution is 100% ALM risk. Focus on the biggest risk. And how do I do that? Well, you say, well, isn't peer risk there? Well, no, we essentially just eliminated peer risk. And I'll talk about how we did that later. We get into that. Asset risk also gets eliminated when you're doing ALM risk because your assets are simply going to match your liability. There's think about it with the life insurance company. They're 100% bonds. Their asset risk is credit risk. It's insolvency, so you have to worry about that credit risk. But beyond that, their asset risk, there's not much to think about. They don't have to worry about, do we put this much in stocks? Do we go to international stocks? What do we do on equity real estate? No, they have assets that back their liabilities, and so that's the assets they buy. So their number two, what they do for number two, asset risk, is really not that big of a deal. So I actually disagree with Arnott here. I don't have that in this article, but I do have it in my blog, so you'll see that. That's part of the essay question on the first exam, is to explain Arnott's solution, and then the counterback was the sweet solution. And most students missed my discussion on the sweet solution. Some of them actually got the wrong solution for the wrong problem. So we'll talk about that. Make sure it's really clear in your mind what we're talking about here. All right, so Arnott's solution, let's balance these three risks. Why does he argue that? You can see that in some of these paragraphs. He asks, does peer risk matter? And here, what he's actually bringing up is the career risk. So he's saying, wow, if you're managing a fund and you're up 6%, and a fund you're at General Motors and Ford Motor, they're not up 6%, they're up 9%, but you're in a lot of trouble. Well, maybe, maybe not. If Ford's up 9 when you're up 6, then next year you could be up 5 when Ford's down 4. Ford's taking some risk. Why should we ignore the fact that Ford's taking a whole lot more risk than we're taking? Why would we completely ignore that and worry the fact that Ford's ahead of us? If you got a friend and they have 100% of their money in Zoom stock, and they talk about what a great investor they are because they put all their money in Zoom, and you're stupid because you have a portfolio that's allocated to 200 stocks or 100 stocks, well, you might feel stupid in 2020 when Zoom was up, a few 100%. But the next year when Zoom's down 80% and your portfolio is up 6, you'll be fine. So you can't use peer risk without acknowledging the difference in the risk of the actual asset portfolio and liability portfolio that you have. So I say, does peer risk matter? It matters once you adjust for the risk. And once you adjust for the risk, then you discover that peer risk really disappears. It's really a very, very small risk. What about asset risk? Well, if your assets are down 20%, that's a problem. But if your liabilities are down 25%, maybe it's not that big of a deal. Maybe you really don't care. So we'll talk about that. So that's what he's talking about in this article. So I want you, before the next session, I want you to have at least read my version of his article. If you want to read his version, the PDF, that's fine. But my version is the Word. I made it look as much like his as possible. We will, in the next session, go into what I did here and how I kept it much simpler than his. I might go look at his version. Maybe after we do this, you might be able to understand his approach. Most students I have a tough time understanding his approach. And then I want you to read my blog. My blog goes much further than mine. Remember, my blog's answering that question, should a firm borrow at 4% to invest in stocks making 8%? Arnott does not address that in this article, and I think it's one of the weaknesses of this article. I wish I could have a discussion with him on that. He's such a brilliant person. I know I'd learn greatly from it, but I might get him thinking about a few things as well. What I want to get to is a debate I had, and I really didn't carry the debate through. I was kind of early in my career, a little intimidated. but I was sitting at a dinner, actually a dinner that Robert Arnott was speaking at, and we were talking about immunizing, doing balance sheet immunization of our pension plan, and this guy from AT&T that ran AT&T's pension plan, he just started laughing at me and how stupid I was. My actuary was sitting there with me, and he was like, "Ron, are you going to say anything?" I was like, "No, these AT&T people, they kind of are intimidating." Today I would have no trouble debating with him. But back then I was still figuring this stuff out. But I'm going to try, I'm making a very subtle argument that I want to make sure you're covering. And if you can figure this out, you are exceptional in finance. You are off the grid, off the chart when it comes to an undergraduate finance major or actual science major. So do your best to understand this because it will move you into a whole new class of student.